So, for somebody who knows nothing about private equity, how would you describe what that is and how is it different from stocks?
Sure. So stocks are basically ownership interests in publicly traded companies. And before those companies get big enough to go onto a stock exchange, to go public and have their stocks traded, they start their life as a startup, right? They start their life as an idea, a business plan, some founders, some backing, and they build on that idea. And as that company progresses, call such things early stage or maybe seed stage companies where the ideas are being seeded and developed and worked on. And if they succeed and they don't run out of money in the process, they continue to grow and live. And so as you progress from that kind of infant stage, startup stage where you're a seeded company and you're making progress, and then later on you're an early stage company, meaning you're not ready to go public yet, but you're perhaps growing and your idea is taking shape and it's being validated by the market. And as you start earning revenues and even maybe earning profits as a private company, you probably are looking to accept private investors who come in and buy your shares on the private side, right? They're not publicly traded, which means those shares can't be easily sold. So the investors come in, they invest in these companies, and sometimes that happens with funds that specialize in either early stage or later stage companies before they go public. And sometimes it happens with sector specialists in the private space, whether it's a healthcare or technology or consumer specialized investor. But the point is, once these investors come on to help you grow the company, you're really at that point trying to get to a point where you can help those investors monetize their what was otherwise an illiquid or highly liquid investment, right? So that might take 5-6 years, sometimes longer, sometimes less time, to really mature and grow that company to the point where it can have an option of going public, or it might be acquired by a larger strategic investor who says, hey, I really like this technology you've developed. I think it would fit in very well with my large public company. And so we'll just acquire you. And that way your investors will have a way to cash out and monetize the private investment that they made. So really the difference is if you're public, you're larger, most likely. Your stock is traded on a very frequent basis. There's liquidity available for you to, as an investor, to monetize your investment and exit it. On the private side, you tend to have no liquidity or less liquidity opportunities. In other words, you can't change your mind 2 days after investing and say, hey, I want my money back. You kind of have to stick with it for the long haul until the opportunity to exit presents itself. And usually these are perhaps smaller companies, not always, but they can be smaller companies usually that are growing much faster because by definition, they're smaller. So if they're making progress, you'll see on a percentage basis higher growth than a much larger company.